For the first 15 years or so of my career, my job was to basically visit bank CEOs and CFOs and help them with their businesses. And whenever I met with them, they would talk about how they wanted to grow their businesses. They're obviously focused on their core operations, but also talked about how they were going to expand and grow their balance sheets. Since the start of the crisis, when I visit these executives, they talk about how they're still focused on their core businesses, but they talk about how they're going to make their banks smaller, how they're going to deleverage out of their non-core operations, and how they want to make them more resilient. And this is the challenge that we in society face, certainly in Europe, and I'm going to talk today to you about that challenge in Europe and about how we can build a better, more resilient financial system to actually deal with that. The challenge can actually be summarized in one number. It's 11.2 trillion euros. That's actually the total amount of Eurozone bank loans that are outstanding. That doesn't include sovereign debt. It's actually the cash that goes to individuals to help buy their houses. It's the cash that's used to finance trade. It's the cash that's used to finance hospitals, roads, bridges. And unfortunately for people in Europe, that actually isn't growing. It's stagnated. You can see that in the mid-noughties, it actually grew quite strongly over the period between 2004 and 2008. And since then, it's come up a little bit, but in the last kind of 18, 24 months, it's actually flat. Many commentators expect this number is actually going to decrease by 2 to 3 trillion euros. That will be a devastating impact on all the people and businesses in the Eurozone area, and also the many businesses and people around the world that these Eurozone banks also finance. And people say, why is that happening? I think this is well understood. It's happening for two reasons. Number one, regulations. We need a more resilient, we need a smaller, safer, better capitalized banking sector. And that's clear. The second issue is that both users and suppliers of finance, so in other words, individuals and businesses, and the bank executives themselves have less confidence. They want to, of course, support their core businesses and their core regions. But in the pieces of their business that are non-core, other countries, other parts of their business, they're looking to decrease that. And that obviously brings down the financial system in totality. Now, you may say that, isn't that just a result of the financial crisis? And isn't that, what's happening all over the world? And the fact is, it isn't. If we look at actually the US, it has been growing its bank loans. It has, they've gone, if you rebase them to 100, they've gone to 102 and 106 over the last 2 years. And as I showed you in the earlier slide, within the Eurozone, that's actually flat and forecast to decrease. And why is that? Well, the first reason is that it's just the US starts from a different place. Their banking system is about half the size of the banking system in Europe if you just focus on the loans. And that's actually pretty amazing if you consider that the economies are roughly the same size. So in the US, the banking system is about 45% of GDP versus about 120 within Europe. So we start from a very different place, and it means that we don't have the room and ability to actually grow and support the economy through bank loans. Why, you may say, is that because the US is less leveraged? It's not. As we all know, the US is actually incredibly leveraged, but it uses a different form of leverage. It uses bond markets, municipal financing, agencies, and much of the lending that goes on to the economy is actually not on the bank's balance sheets. The banks can actually focus on supporting businesses and individuals that are maybe non-conforming. I think that what we want to talk about is how do we create a higher quality financial system? How do we focus on the future rather than just focusing on the past? We need to think about creating a financial system that can support the individuals and businesses within the Eurozone area so that it can grow. And some of the characteristics, I think, of that financial system are, first of all, a more diverse range of options to source financing. You'll see that there's a number of initiatives now within various countries where we've peer-to-peer lending, both in a very, very high-risk way through venture financing, but also in a low-risk way. Also direct financing of industry and the economy by long-term natural holders of exposure. So there are lots of pension funds and insurance companies who want long-term finance, perfectly matched to the kind of money that's required to build big infrastructure projects. Banks are not going to supply that money given what's happened in the regulatory system. So we need to make it easier for those pension funds and insurance companies to supply that. The big thing that's actually going to really move the needle is actually making Eurozone bond markets larger, more liquid, cheaper, across high-grade, sub-investment grade municipals and projects. And that really means about more harmonization, making the market larger. There are lots of little things that can be done to help that. If you're a bond investor at the moment and you buy a bond from a company, say, in France, you have to understand the bankruptcy laws within that country. If you want a kind of a Eurozone bond market to be larger, more liquid, people need to understand the bankruptcy laws in each individual country. A harmonization of those laws, we believe, would actually lead to a much larger, more liquid market over time. And then finally, we need deep, liquid, private, public, and venture equity capital markets. I showed you earlier that the banking system is many times the size of the banking system in the US and in the Eurozone. If you actually look at it from an equity perspective, it's the opposite. Our equity markets within Europe are actually half the size of the equity markets in the US, and our venture equity markets are actually many times smaller. In relation to the financial system, I feel that much of the dialogue and focus is still about looking back, but I also think now is the time to focus on the future. How do we build a better financial system, a system that can actually finance society for the next 5, 10, 15, 50 years? And that's going to take a lot of effort and thought by a lot of people in policymaker positions in the markets and in businesses to figure that out.